welcome back. We've gone through a ton of market analysis you sent over, and wow, there's a clear theme emerging. We're definitely operating under some pretty profound structural pressure.
That's putting it mildly.
So our mission today, a really quick deep dive. We've picked out 6 key insights from the sources, and they all kind of tie back to this hidden cost, the cost of global debt and inflation.
Yeah, it's all connected.
We'll just walk through them one by one, source by source, and pull out the main takeaway for you. Let's dive right in. The first source, investing in a debased world, really sets the scene. It talks about global debt.
And the number is just staggering. $340 trillion.
Trillion.
Yeah, which is, what, 325% of global GDP? It's a lot.
So what's the core insight there? How do we even deal with that?
Well, the conclusion from the source is pretty stark. Inflation isn't an accident anymore. It's becoming the tool, the intended solution.
The solution.
Yeah, it's the main way governments can dilute the real value of all that debt. It's a strategy, actually. They call it financial repression.
Okay, financial repression. What does that mean exactly?
It basically means keeping interest rates lower than the rate of inflation on purpose to sort of chip away at the real debt burden over time.
Oh, okay.
And that explains why you see hard assets performing so strongly. Look at gold, up 50% year to date. Silver, up 66%. They're reacting to this, currency debasement.
Right. Okay, so if that's happening, what about equities, like the S&P 500? Because the next source, real versus nominal, points out it's doubled since 2020 nominally. Over 100% gain.
Exactly. Nominally, it looks amazing.
But if the money itself is being debased...
That's the kicker. That's the aha moment in the analysis. When you measure the S&P 500's return, not in dollars, but in something like gold.
In real terms.
In real terms, yeah. Expressed in gold, the index has actually lost over 18% since 2020.
Lost money.
And get this, the S&P's compound annual growth rate since 2008, about 11.2%. Sounds okay, right?
Yeah, decent.
But the Fed's balance sheet grew at 12% CAGR over the same period. So if your investments didn't beat that 12% expansion...
You actually lost purchasing power.
Precisely. The currency was debased faster than your investment grew. You lost ground in real terms.
Okay, that really changes the perspective. So if inflation is the intended path, how are governments signaling this? The source, global repression, talked about Japan.
Right. The political shift in Japan was a big signal. Sana Takachi's victory in the LDP leadership election, that's Japan's ruling party.
Then why was that significant?
Because she's very openly pro-stimulus. The market saw her win and immediately thought, okay, Japan isn't going to hike rates aggressively. The Nikkei index shot up nearly 5% to a record high.
Wow.
But there's always a price, right? The yen sank further, hit 155 against the dollar, bond yields went up. It just confirms the playbook. High-debt nations are likely going to let inflation run hot. They almost have to.
Which naturally shifts where money flows. The source, Emerging Bets, talks about this pivot. Investors looking away from the U.S., maybe towards emerging markets.
Exactly. After things like the U.S. tariff hits, investors are rethinking that U.S. exceptionalism narrative. EM, or emerging markets, suddenly look more attractive.
Why is that?
Well, generally, you're looking at better valuations, lower debt levels compared to the U.S. or Europe, higher yields, too.
But more risk, right? More volatility.
Typically, yes, that's the trade-off. But investors are weighing that against the potential weakness in the dollar and the debt situation in developed markets. They see a margin of safety there.
Okay. Let's talk about warning signs. The source, Warning Signs, mentions gold breaking $4,000 as a stress signal related to government debt. But is the stress just in the public sector?
No, not at all. And that's a key point. The stress is definitely showing up in private credit, too.
Private credit, so loans to smaller companies.
Exactly. Often riskier ones. And you can see the strain in publicly traded business development companies, or BDCs. These companies manage private debt portfolios.
And they're struggling.
Some are, yeah. The analysis points to default rates potentially hitting 8% next year, even with loan modifications trying to keep things afloat. And here's the thing, these BDCs are yielding around 14%.
14% yield.
Right. But investors are still questioning the creditworthiness. When you see that kind of yield paired with that kind of doubt, it's a serious red flag about underlying fragility in the corporate sector.
Okay, one last major piece. The source, the energy aspect of AI. This feels like a huge structural issue.
Yeah.
AI's energy needs.
Oh, it's massive. It's potentially the Achilles heel of this whole AI revolution, at least in the medium term. The numbers are just huge.
How huge?
Projections are saying AI data centers could consume 2,000 terawatt hours of electricity within 10 years.
2,000. How much is that?
That's about 6% of the entire world's current electricity generation, just for AI data centers.
Wow. And where's that energy coming from now?
That's the irony. Mostly fossil fuels still. So this futuristic tech boom is running headfirst into a very old world problem. Energy supply and infrastructure, it underscores just how urgently we need to revamp our grids, accelerate nuclear, solar, wind, everything.
So tying this all together then, whether it's the S&P's real returns vanishing or AI's energy crunch, it all comes back to these massive historic pressures, driven fundamentally by that $340 trillion debt pile.
It really does. The whole system is straining under that weight. Which leads to a final thought, something for you, the listener, to really chew on.
Okay, what is it?
If all these sources, this consensus view, points towards financial repression and inflation being the, let's say, unavoidable path for governments drowning in debt, then what investment strategy actually works for traditional debt-based assets in real terms? Where does sustainable cash flow even come from in that kind of environment, looking years down the road? It's a fundamental challenge.